The following presentation is brought to you as a courtesy from Forex Academy. This is part of our service, Become a Pro course. If you find it interesting and wish to be updated on new releases, please subscribe to our YouTube channel or join our community at forex.academy and receive all our services for free. Your like is also highly appreciated. Enjoy.
Now I'll give you an example of what not to do. So we went through some very well constructive trades there. Now we have a lot to cover in this lesson, so I know we have discussed a lot of confluence here, but it's very important. The question I would like to ask is, what seems to be the problem here? What seems to be the problem here? Well, guys, this is not how to use technical analysis. What use? Let me go through this in a little detail. First thing I notice is this price channel here. Tell me, what use is this price channel right now to relative price action here? It's of absolutely no use, okay? So that is not how to use a price channel, of course, and even if you're trying to relate price channel to something more relative, this price action is not trending in any fashion and it should not be subjected to a price channel. Okay, so that's the first thing I notice. Well, what is the indicator here? It's a momentum indicator. Of course, that sounds quite silly in terms of looking at the price structure right here. There is no clear momentum in the market. We're getting red candle, green candle, red candle, green candle, and look at the size, look at the ATR, the size of some of these candles here. They are very, very large. So there's no real momentum in the market at this moment. You can tell by the price action, guys. So that is the wrong indicator to use there. Okay, so we have a few things going on with this market. Again, the Bollinger Bands, guys, you know, they're looking to tell us the volatility in the markets. Really, they're the wrong indicator to be using at this point, because it's clear to see we can use the observation of the Bollinger Bands here. But in terms of, you know, where they used to be, and I'll just take some of this off screen. Let's just look at the Bollinger Bands here. Look how contracted they were here. This tells us that there's no volatility in the markets. We can see that there's crazy volatility in the markets, guys. Look at the volatility from high to low of these Bollinger Bands. You know, here is a very short period of time when there's contraction, but again, I would not call that contraction just because we've seen crazy volatility. Look how it expands again. It's just the wrong indicator to be using during very, very, very volatile markets. Okay, when you see a big move like this to the downside, you may forget to use Bollinger Bands. Forget about using Bollinger Bands for the short term, guys, until the momentum, or sorry, until the volatility starts to decrease in the market. Okay, and then of course we have a level of support and resistance, and what I would suggest is, guys, you should take this with a pinch of salt, you know, because that is not the best time to use a level of support and resistance, guys. You know, the first time you use that level here, it's the most volatile trading day perhaps in the whole price action. Then it has been broken, of course, albeit it has been rejected. But I mean, the trading range of this day is a huge, an absolutely huge candle. Then we see it broken again. Okay, so already the basis of this structural level of support isn't holding up, and then the market doesn't come down to it at all. Even here, when it does, effectively the first time it does, it closes below the level. Of course it trades up again, but you know, we're seeing continued breaks of this level. It's never been holding up really, this level. Okay, so it's not, you know, using a level of support and resistance when the market is continually breaking the level and showing a lot of volatility isn't using effective technical analysis. So for me, this consciousness of technical analysis does not hold weight, and this is not how to use technical analysis properly. Okay, so let's move on then, and we're going to have more of a theoretical discussion. First of all, we're going to discuss a Dow theory. Okay, among trading circles, most consider the father of technical analysis to Charles Dow, founder of the Dow Jones Dow Jones and Company, which of course publishes the Wall Street Journal, still does to this day. Around the 1900s, Dow was analyzing the movement between the Dow Jones Industrial Average and the Dow Jones Average Transportation Index, and he noticed that these two indices tend to trade in a predictive, similar fashion over time. So just some context for you here on Dow theory. Although his papers were written over 100 years ago, investors and traders alike feel that his findings are relevant today as they explain some form of correlation between similar asset prices. Some form of correlation between prices, of course there is, guys. And we now know that. You can do simple correlation studies by using a Microsoft Excel document by simply taking the highs and lows of closing prices of your set two markets and doing a simple correlation on Microsoft Excel. So anyway, let's discuss the 6 tenets of Dow theory. The first tenet: the markets have 3 trends. Okay, so Charles Dow believed the markets have 3 trends. Trends have 3 phases. Okay, all trends have 3 phases. The markets discount all news. That sounds familiar, and we'll get to that. The averages must confirm each other. Trends must be confirmed by volume, and that's very interesting. The trends must be confirmed by volume. The more participation entering the markets, well, the more we can take from that. The more interaction there is in any market, of course, the more price discovery there is. Does that make sense? And trends exist until definitive signals prove they have ended. So let's discuss tenet 1, the markets have 3 trends. What he believed, of course, is that we have an uptrend, a time when successive rallies in a security price close at levels higher than those achieved in previous rallies, and when lows occur at higher levels than previous lows. Okay, so higher highs, previous lows, we see an uptrend. That is, of course, one market trend we've all become familiar with. A downtrend, of course, when a market makes successive lower lows and lower highs. Okay, and then more interestingly, a correction. When a market makes a strong move in one direction, then recedes from that direction before continuing to trade in that opposite direction. It's effectively what we've seen here, albeit with a lot of volatility. I believe that market is the euro pound. And I'll just highlight this for some of our viewers. A correction, so what we've seen is a very strong trend to the upside. Okay, we've made a very strong trend. We've seen a high, then we've seen a correction. That correction becomes deeper and then continues to trade lower. Okay, continues to trade lower, and albeit there's been a lot of volatility, but we are still trading to this day lower in this price action here. Okay, so let's just take that analysis off, and we've all got a chance to see that. So an uptrend, a downtrend, and corrections. So markets have 3 trends. Trends have 3 phases. Okay, so 3 phases. Let's go through them and then we'll discuss them in some detail. Why might markets have 3 phases? Okay, well, Mr. Dow believed, of course, there was an accumulation phase. This is our accumulation phase. Okay, so if we think of this, expert traders, perhaps, and investors, all of those in the know, perhaps, and as the markets start to rise, you can see there's less volatility there. Expert traders and investors accumulate their long-term positions in the market. Okay, so they have knowledge. Perhaps the financial institutional traders, they're making the trades, and we see accumulation in the market. Phase 2, the public participation phase. Okay, so all of us guys, perhaps, the public at large, begin to catch on to what the expert investors and traders know and begin trading in the same direction. And then we have the excess phase. Okay, excess, where the smart money perhaps starts to exit the trend, but we see continued volatility perhaps until until there's that euphoria. Even at the institutional side, all of these investors are piling in. The markets are going up so strongly, the profits are so great, there's always excess. Isn't that interesting, guys? Isn't that interesting? Because this is Mr. Charles Dow from 100 years ago, albeit in the 1900s there. But I can think of 3 off the top of my head, very strong examples that reflect this scenario, where we had the dot-com bubble, investing in the tech, everyone floating, first of all, publicly their tech companies, and leading to a bubble in tech. And obviously the big money and accumulation was in the tech. The public participated, there was excess, then we had a crisis. Okay, we had a bust of the bubble. And then if we think of the housing crisis, of course, that was the same thing. And if I think to all but maybe 4 or 5 months ago, there the Bitcoin, which traded at a premium there to $20,000 for a coin there. So we had the expert traders who were in the know trading this market way up from when it was almost nothing. 6 months or 1 year prior to today was perhaps $2,000, $1,000, $2,000. We had the public participation trading that the whole way up, with institutional trading up to $20,000. And then we had the excess increasing that speculation, bubbling it up until effectively, the excess euphoria ended when the market experienced a short-term crash to around, I think the lows were around $6,500 from a premium of $20,000. So again, that is very interesting. I suppose very vivid observation by Mr. Dow. Tenet 3, very familiar indeed. Trends have, that is a mistake on the slide there. Of course, we result our efficient market hypothesis. The efficient market hypothesis asserts the financial markets are informationally efficient, or that prices on traded assets, i.e. stocks, bonds, or property, already reflect all known information and therefore are unbiased in the same sense that they reflect the collective beliefs of all investors about the future markets. Okay, so I believe the Tenet 3 was that the market discounts all information. Doesn't that sound that sounds very, very familiar to us? We've discussed this throughout the Become a Pro course, of course. The market discounts all available information, and that is embodied in the price action. So we trade the price action as is. Tenet 4, the averages must confirm each other. Okay, so what we have on screen here is, well, we have, first of all, price action from the Euro Stoxx. In fact, it's a line graph, or Euro Stoxx 500 or 50 score, excuse me. We have the IBEX 35, which is the Spanish index there, otherwise known as the MEF, and the German DAX 30. Okay, so 3 European stock indices. Of course, over the long run, they are correlated. Very interesting. So not as relevant in terms of his own study with the Dow Jones Industrial Average and the Dow Jones Transportation Average Index. At that time, the US economy, just some information, this study was done with those two indices. The US economy was moving and trading as a result of the large amount of manufacturing firms within. Now we're driven towards the services sector, of course, driving investment. So not as familiar, yet it set a precedent and yet very relevant for similar equity markets and many markets that share correlation today. So other averages must confirm each other. So when you're trading gold and gold makes a very strong move to the upside, then you look at the silver market and you're looking to trade that market. Well, shouldn't there be some sort of correlation there? Shouldn't the averages between these markets over the long run confirm each other? That is what Mr. Dow was explaining. And of course, it has led to statistical correlations in a numerical form, which I touched upon. Basically, you can do that, guys. You can simply take some price data. If you choose price data over the last year for the S&P, the NASDAQ, and the Dow Jones Industrial Average, 3 equity indices, okay? And you simply take one figure for each day. We take, for example, the closing price of each market. So 3 markets there, okay? The S&P, the NASDAQ 100, and the Dow Jones. And then we choose that as a sample, perhaps. Now, it won't be 365 days, of course, over the last year, as the markets aren't open every day of the week. But let's say we have roughly around 260 days of price action closing prices. We can simply correlate, put them into Excel and correlate those prices by using a correlation series, and that will give us a level of correlation between them, a statistical correlation. We can describe it as a number, correlated number, or as a percentage of K. So what you're going to find is, of course, that they are very, very correlated indeed. And tenet number 5, trends must be confirmed by volume. Okay, and this is a very simple chart. What we've seen is US oil over the long term. So this is perhaps over, well, it stems back there the whole way from February 2017 to today's price action, which is great to see. However, let's take a reference point here when we see the start of the bull run roughly around July 2017. Okay, the bull run is from around $41 there to $70 now, so that's fantastic. Fantastic move in this price, this asset. However, what we see very, very significantly on chart is the significant average increase in volume over the long period. So when we look at this market, is the trend confirmed by the volume? It most certainly is, and that is a very vivid, inspirational piece of insight from Mr. Dow in terms of his Dow theory. And the last tenet theory, of course, tenet 6, which we can all discuss, it's very interesting as technical traders, is that trends exist until definitive signals prove they have ended. And we can all discuss this. This is where the debate of technical analysis takes us in terms of trying to define what those signals are that prove that trends have ended. And that is why, in fact, guys, we use technical analysis. We try and answer this last tenet, okay? But we take it as an assumption and we collectively use these tenets in Dow theory. Let's move on to Elliott wave theory. So very, very interesting indeed. Very, very interesting in terms of application. And you'll see it over many, many asset classes, most particularly, guys, the Forex pairs, because they do trend, but they tend to trend in much more of a volatile fashion. Okay, so Elliott wave theory, discovered by Ralph Nelson Elliott there. We have a predictive versus a reactive nature to trading Elliott wave. Market prices trend and reverse in a very recognizable pattern. These repetitive patterns take the shape of waves, and it is not a forecasting tool, but detailed descriptions of behavior of markets, i.e. insight into mass psychology. Isn't that interesting? Okay, so he's not trying to predict or forecast how the market moves. We're trying to trade off mass psychology here, and we know that that is simply one interpretation of the financial markets, guys. Mass psychology in price interpretation. So let's discuss these patterns in context. Okay, so this is what the first Elliott wave pattern looks like. Okay, we have waves. The market trades from low to high, potentially in a bullish trend, and we see, of course, we have inflection points 1, 2, 3, 4, and 5, with the waves making those turning inflection points. What is very interesting to note is that there are rules to this Elliott wave theory. Wave 1 and 3 and 5 affect the direction of the market. So that is conclusively going to call out the direction of the market. Wave 2 and 4 counter moves 2, 1, 3, and 5. So they're simply counter trends. And when we see them starting to formulate in the markets, well, that might be a simple time to say, well, look, let's not get in and let's get not involved in the trend at this point. Let's wait until point 2 arrives or point 4 to look for the best opportunities. Wave 2 never moves below wave 1. Isn't that an interesting observation, guys? If that is the case, and we see, let's say we study Elliott wave theory, we like it. We don't have to use it for all markets, of course. But if we see this structure start to form here, and we have wave 2 here, well, it never moves below wave 1 at this price. So we see this start to trend to the upside, then the trend is intact. The trend will not break down if you're a long-term trader and you get a strong move to the downside. Then you know you can exit at these prices. Okay. Wave 3 is never the shortest. Wave 3 is never the shortest. Okay, so we're seeing this is always the largest expansive move. Okay, and we'll include that in our theory. And I'll just remove some of this analysis on screen so we can see the pattern. And wave 4 never enters wave 1, and of course the same. Okay, so we get this low never entering wave 1 at all, so it won't break this high. So this will allow us to actually, you know, capture risk in terms of not only placing stop losses, but let's say we buy the market here, it can't trade down to this price with our rule here. As the market moves up, we could look to buy the market again at this price. As it trades up, We know this is going to be the most extensive move. This is wave 3. And then we could place our stop loss, of course, as we enter the trade here within a remit of point here. And as the market moves up, we know, well, wave 4 never enters wave 1. So effectively, we can collectively use these stop losses to say this is our break even or maximum risk on the trade, okay? So you can see how you can start to combine. And remember this, guys, that you can actually apply the Elliott wave theory to smaller time frames as well. So to much smaller time frames. So it is something that if you're looking to purchase the market here and you say, well, I don't want the market to pull the whole way back to here. Well, what if it's a short-term trade for a potential day trade and you see the market moving up within the day, and this is the open of the market during the course of the day, and this is the close. You can get a great amount of volume and traded in that particular day according to the wave theory, if the market trades as such, of course. So let's move across. There is wave development within the wave theory, okay? Wave development takes place in 2 distinctive phases, and we've looked at one of them. The first phase is the 5-wave structure known as motive waves. So this is the motive of the market moving. The second wave is the 3-wave structure known as corrective waves. Motive wave and corrective waves together form the complete wave cycles of 8 waves. And this is what we have on screen here, our 8 waves cycle. This is the complete Elliott wave cycle, okay? And again, our motive waves are moving from 1 to 5. Corrective waves are A, B, and C. At any given point of time, markets are to be identified somewhere in this cycle, okay? So at any given point, now this is obviously an assumption of the Elliott wave. You won't see this, play out all the time, but at any given point, the markets are said to be somewhere within this cycle. And it is, of course, important to follow the rules rather than to form opinions. And that is what we're going to look at just to finish off Elliott wave theory. So, of course, we have our waves. We know that there are good times to buy the market, of course. We know that we have, if you're following Elliott wave theory, if you're correct at this price, say, by buying the market here, a break of this price, well, you could simply place a stop loss at the last corrective low, because we believe that this is going to be the most large, the most conclusive move in the markets, okay? This could trade up to new highs here, and then we'll start wave 4 here and wave 5 to new highs again. So try and build in this to your analysis, of course, depending how the market trades. But it is, of course, important to follow the rules rather than to form opinions. Let's look at these rules or guidelines, as we call Elliott wave guidelines here. Guideline 1, when wave 3 is the longest impulse wave, wave 5 is approximately equal to wave 1. Guideline 2, the forms for wave 2 and wave 4 will alternate. If wave 2 is a sharp correction, wave 4 will be a flat correction. If wave 2 is flat, wave 4 will be sharp, okay? And guideline number 2, after a 5-wave impulse advance, corrections A, B, C usually end in the area of prior wave 4, okay? So you can start to build this into looking at waves within the markets, guys. Again, you have all this to revise so that you can go through the context. What I would advise you to do is pull up some market price action. Let's pick some Forex markets, 5 Forex markets. See if you can pinpoint some Elliott waves within the price action structure. See if you can do some demo trading, or perhaps looking for price points where you can pick that the rules actually apply. And of course, perhaps wave 3 is always the longest impulse wave. That may be the case. If that's the case, you should know then how you look to trade that. And when you see it again with guideline 2 here, you're going to know that there are certain corrections in the market. If wave 2 is a sharp correction, what does that mean in terms of trading wave 4 and vice versa? Okay, so start to incorporate this into your trading, guys. Of course, it is totally theoretical. Some of you may choose to ignore it. The important thing is, of course, that you're learning it, that if you see it appear in the markets one day, you'll be able to say, well, I know that this explosive move is supposed to be, we're now on wave 3, this is supposed to be the largest move of this wave. If you're in a position at that time, and you see that starting to form, well, that could give you a little bit of maybe courage or impulse to say, I want to stay in this trade. If it starts to move, I have more convictions given what I've learned. Okay, so there are different ways that you can use some of this theoretical context as well, in terms of combining some of the technical theory with things like technical confluence in succinctly trading with technical analysis. So on to our lesson summary then. I hope you have enjoyed this lesson. It's been quite technical indeed. Technical confluence is there to add probable outcome to our trade selections, not to confuse our trading strategy, but to complement any potential technical ideas we may have. Theoretical ideas can supplement your trading knowledge of market movement and explain why securities move in similar fashions. Again, disregarding fundamentals, we're not focused on the fundamentals in particular when trading technically. And we still choose to observe the price action in developing a technical methodology. And I had that in the last lesson. I wanted to include it again in this lesson summary because it's so important. We looked at technical confluence, how we use all of those technical indications together. But remember, guys, that observing and studying the price action to give you those signals to best enter the price or to best enter the market in accordance with the technical analysis that you have will make you a better trader. So we still choose to observe the price action in developing a technical methodology. Okay, so that'll do us for today. Congratulations, guys. We have now finished webinar 11 of the Become a Pro course. I know we've taken in a lot of fundamental research. We've taken in a lot of discussion over sector analysis, economic data, our study of price action and technical analysis. What are those components of technical analysis? You have all of this to revise in your members area, so do make use of the recordings and all of the education in Forex.Academy. It's there to serve you guys, of course. What I'll do is let you go for the evening. Thank you very much for joining us here at Forex.Academy. We'll see you next time. Bye for now.